This is frightening. I'm your host, Steve Van Metre, and thanks for joining me today. In our lead story today, Taco Bell just issued a terrifying warning. I'll show you why I'm worried, because as you're about to see, what's happening at Taco Bell is quickly spreading across the entire U.S. economy. And we have new evidence the AI bubble is about to burst. And is the media now covering up the true state of the economy? The shocking truth is revealed. Stay tuned. Plus, we have a sponsor for today's show. We'd like to welcome Janover back to the show. You can find them on the NASDAQ under the symbol JNVR. And the reason you want to check them out is because the last time we featured them on the show, the stock gapped up and then rallied 35% in one day. We're seeing the same setup then as we're doing now. And we'll talk about how they just entered a licensing agreement for their AI client engagement tools. Stay tuned to the end of the show or check out the pinned comment or description for more information. Now let's head over to Bloomberg, where we picked today's story up with the headline is KFC owner Yum Brands disappoints on KFC and Pizza Hut weakness, but the company is pointing to bleak consumer sentiment, and this is a huge problem because one thing we've come out of the pandemic that everyone believed that the economy was going to slow down. In fact, the Fed came out and said, look, we're raising rates with a specific intention to bring demand down. We want to cool the economy off. The problem is there's some underlying issues here that we're going to see are going to get much worse because what's happening at Taco Bell right now is spreading across many different companies and is an ominous warning for the entire U.S. economy. Taco Bell's comparable sales rose a mere 4%, outpacing expectations. But I want you to understand, when you inflation adjust that number, it's less than 1% growth. And this is not what we're looking for in a soft landing or even a no landing scenario. What this says, we're on a pause on another trend down in the economy, and that for many Americans is the worst possible news. But the company's overall performance in that metric declined 2%, deeper than estimates. Yum pointed to weak consumer sentiment and geopolitical tensions, including the Middle East, as the root of the challenges. And this is important because when consumers lose confidence in the economy, it's all about the labor market. So when they see their hours work get cut, even though they're still getting pay raises, or they're seeing their coworkers lose their jobs, or even they're at risk of losing their jobs, one of the first things consumers do is cut eating out. And that's why this is very important, because it's a leading indicator of where the economy is going. And Yum, as the latest restaurant operator, illustrate the difficulty of enticing budget-conscious consumers to dine out. Chains such as McDonald's have made progress in reversing traffic declines in the U.S., but the picture remains bleak across the industry. And again, this is a big issue for the economy because we're supposed to see a second half boom, and yet instead consumers are further tightening their belts. They don't have the discretionary income. They're not spending money. And this isn't a domestic issue. This is a global issue across Europe and Asia. We're seeing less and less money in the broad economy. Consumers all around the world choosing to eat at home instead of out. And again, that is a leading indicator of where the broad U.S. economy, where the global economy is headed. And until we see a turnaround here, things are going to get much worse. As restaurant brand sales miss on Burger King, Popeyes slump, and again, they're struggling to attract diners coping with inflation. So we hear weakness in demand. We see inflation issues. This is all about the consumer. This is why we focus on what's going on with the labor market so much, because even though we're seeing incomes rise, even though at a slower pace, hours worked are stagnating. They're just not growing, and that is an issue because workers are finding out that inflation isn't coming down fast enough. And something that we note is the consumer price index doesn't cover everything. It doesn't cover things like insurance costs. It doesn't factor debt service costs that consumers pay. So what we're seeing is a further degradation of household incomes here and showing up in the restaurant space. But this is dangerous because if people don't eat out, well, it means we're going to see more restaurant closures. And something we talked about with the TGI Fridays bankruptcy is this is only the beginning, particularly when you think about the work from home or hybrid movement. People don't eat out that much. Why are companies like Starbucks and Amazon pushing workers to go back to work? Well, because they're going to face another issue that we don't even want to see yet, and that means more store closures all across the inner cities. This is not a good sign. The group eked out a 0.3% gain in comparable sales. Well, when you adjust that for inflation, it was negative. And yet this is a problem because comparable sales declined at Burger King, Popeyes, Louisiana's Kitchen, and Firehouse Subs. who North America businesses are concentrated in the U.S. Tim Hortons, which is the bulk of locations in Canada, and remained a bright spot, as well as Restaurant Brands International business. Sales by that metric fell 0.7%. Again, you tack on inflation, it's an even bigger negative number. There at Burger King, 4% at Popeyes. Well, comparable sales were up 2.3% at Tim Hortons. So you think about these negative prints that these restaurant groups are seeing, and that means they're going to be forced to close underperforming stores. Those stores who are not seeing the demand, they're going to cut hours and slowly going to backfeed through the economy. You know, it doesn't happen all at once. It happens slowly, and then it happens quickly. We're kind of in a lull right now before we make the next move down, and that is what we're seeing here. And yet, the discounts and meal bundles aren't enough to woo customers, which is, again, evidence that inflation's too high and the total incomes are not high enough. Because when you see prosperous consumers, when they're feeling good about the economy, one of the first things they do is they love to go eat out. At this point, they're making a decision. In fact, despite the issue that you see restaurants lowering prices everywhere they can, consumers are saying still not enough. Novelty like Burger King Adams Family promotion featuring a Purple Whopper is crucial too, but even then, as Wendy's noted, that's not working. If you only have value, the only thing you're offering, you're missing an opportunity, and that's to upsell at least those who have money. The problem is if you don't have value, you don't have any customers. And we can see this evident in the data. When we look at real retail sales, this focused on the retail food services sector, adjusted for inflation, that's shown in blue on a year-over-year rate of change against total incomes as a function of average hourly earnings multiplied by average weekly hours of production and non-supervisory employees. That's shown in red on a year-over-year rate of change. You can see a very clear picture as incomes start to peak and then roll over. What happens is real food sales start to decline. And you see that here right around 2000. There was a really high print here in food sales, and then it rolled over as restaurant traffic fell, as consumer incomes peaked out. You see that same thing happening again going into the global financial crisis. And look what came out of the financial crisis right around 2011. Incomes decelerated, and what happened? The same effects at restaurants followed. And here we're seeing it once again, a big plunge in restaurant sales down to virtually a negative print for the last 2 years. And what are we seeing? A downward trend in total household income. But that's showing people that have jobs. What we're missing here from that picture is those who don't. Of course, when you don't have a job, you tend not to eat out because your income is down. But that means, of course, we're going to see a further decline in the economy. Again, the trajectory here is what matters. And as long as demand continues to remain weak, that means employers are going to cut hours, they're going to cut jobs, close stores. They're going to have no choice. Because when we take a look at what's going on in Stellantis, as we look across the broad U.S. economy, we see further signs that discounts aren't big enough, as they cite progress on U.S. inventories as revenue drops. But something we're going to show you they should have a lot of progress on, and that is an investment in Janover. As we look at them on the NASDAQ, under symbol JNVR. Now, the last time we featured them on the show, the stock gapped up, and then that day rallied 35%. Now, I want to show you, this is the 90-day chart. You see the volume profile line here, and what that indicates is where buyers are and sellers are at, and a close and a rally over that 56-cent level could see the stock shooting up as much as 35%. Stay tuned to the end of the show for more charts, or check out the pinned comment or description for more information. Because earlier this month, the owner of Jeep and Fiat brands reported declining third quarter vehicle shipments. Now, when you have a decline in shipments, that means at the factory level, you're going to be cutting hours, you're going to be cutting production down, because you don't need that many vehicles. So keep that in mind, that at the factory level, they're still not producing what they can, and that was led by a 36% drop in the key North American market. Stellantis said on Thursday it reduced its U.S. dealer inventories by more than 80,000 units in the 4 months through October. And if you want to know how they did that, well, it was very simple. It's called discounting. Again, you see price cuts happening in food services. You're going to see it happen in the car industry. And you come back again. Why why are we seeing such a decline in auto sales here across the board? Has everything to do with demand. You have to think about people that work from home, they don't drive as much, so it makes perfect sense. People who are commuting 5 days a week, well, they go through vehicles. They want a nicer vehicle to commute in, but when your car is being parked maybe 3 days or more a week, you certainly don't put that many miles on it. Again, this is a dangerous problem for U.S. manufacturing. What we're going to see is further consolidation in terms of production in automobiles and a decline in demand. That means more American workers eventually hitting the unemployment line. And when we talk about the AI bubble bursting, well, Foxconn notes that sales growth slows amid underwhelming AI-enabled iPhone upgrade supercycle. And this is something we've been warning about, is that AI technology, well, not many people even understand what the benefits are, let alone why it's worth a major upgrade. In fact, what we're seeing now is consumers are saying, yeah, I'm not really that interested in it because the search engine seems to do the same thing and doesn't require me to buy a new phone. And last week, Apple earnings revealed Apple Intelligence was a dud. It did not spark a massive new iPhone upgrade supercycle that investors in Wall Street were hoping for. Sales in China slid for the 5th consecutive quarter as Hawaii continued taking market share. But if we continue to look across the U.S. economy, we see demand declining everywhere. And now Marriott profit misses estimates as hotel firm lowers their outlook. But this is interesting because it's the excuse that everyone has right now, and it's the election. The problem is that excuse ends, well, tomorrow. As shares of Marriott International slumped 2% on Monday as the hotel company slashed its adjusted earnings per share guidance for the year. During a Monday morning earnings call, the CFO told investors that consumers had pulled back on travel this month, citing headwinds around mounting U.S. election uncertainty. And this is something we continue to hear company after company use as a reason why demand's down. The problem is, again, this ends tomorrow. Besides the Marriott, earnings call mentions of election has surged this earnings season, surpassing the number of mentions in the prior cycle and rivaling the 3,000 plus mentions in the fourth quarter of 2016. So again, what we're seeing is a broad slowdown in the U.S. economy. We're starting to see the effects of what is the work from home movement, the hybrid work schedule. At the same time, we're seeing the money from the pandemic stimulus now be drained away. We're seeing broad signs of a slowdown in demand. And companies don't want you to know. They don't want to tell you the truth. They want you to think it has everything to do with the election. But is the media helping with this cover up? Well, let's take a look at the U.S. services activity because it grows now at the fastest pace since mid-2022 as everything seems to be picking up. The Institute for Supply Management's non-manufacturing or services index increased to 56 on October, the highest since July of 2022. And here you can see, looking at this chart here, it was stagnating at 50 or unchanged, and then it started to take off. Employment went from contraction now into expansion, suggesting that perhaps the mythical soft landing is indeed here. But that's not the entire story. The ISM's employment index climbed nearly 5 points to 53, the highest since August of 2023. Further job gains paired with low unemployment and limited layoffs would support Americans' ability to keep spending in the months ahead. And there you see the media saying, hey, look, we're about to achieve the soft landing scenario. The Fed cut 50 basis points. They're probably going to cut again 25 on Thursday and maybe another 25 on Friday. This is a sign. All these companies have been telling you the election's been holding back a bunch of pent-up demand, and this is all we're seeing now is a change in the services index. But there's a reason why I just wanted to show you what's going on at Taco Bell and Burger King and other companies, because what they're telling you, there isn't a significant change. And when we look at why this happens is because we see real retail sales now. This is, again, inflation adjusted, shown in blue, against the unemployment rate. This is the other side of the story that nobody wants to talk about. So even though we're seeing some slight increase in hiring in the services sector, its odds are it's all based on holiday demand. We see a lot of seasonal effects here, but look at this. When you see real retail sales on a decline, usually the unemployment rate eventually bottoms out and turns up. Again, why is that? You get store closures, you get hours work cut, you get jobs cut, and eventually it leads to Americans hitting the unemployment line. You see that relationship again around 2007 as the decline in real retail sales began somewhere around 2005. It just took a while before it hit the unemployment line, and next thing you know, Americans were looking for work and didn't have any opportunities. This time we've gone 2 years with real retail sales showing a negative print. Only after a year we started to see layoffs begin. We're going to see even more because the report paints a more resilient labor market picture than offered by last week's monthly job report. Again, saying that doesn't matter what the BLS says, but here's the real issue. We continue to share with you that the Bureau of Labor Statistics is printing inaccurate numbers because they don't have local workers. Now, they used to have people in the different regions and districts, foot on the ground, doing the actual payroll data. This has all been concentrated now in Washington, so the actual data is highly inaccurate. And then all of a sudden we get that 12,000 print in October. The media says not to worry. It doesn't matter because the step down in hiring was distorted by hurricanes and a major strike at Boeing. It can't be from the fact the economy is slowing, but yet we have strong evidence that's what's really happening. American voters are headed to the ballot box today will have repeatedly listed the economy as a top concern in this year's presidential election, and people that list the economy as a top concern is because their incomes don't keep up with inflation and they're worried about their job. That doesn't tell you we have a strong, robust, and resilient labor market. The report also showed a gauge of supplier deliveries jumped to the highest level in more than 2 years, indicating slower deliveries as a sign of increasing demand. Exports grew at a more moderate pace while imports barely expanded. The measure of prices paid by service providers for inputs indicated costs grew more slowly this month. But here's the thing. While the index is generally in line with pre-pandemic levels at 58.1, the data suggests consumer prices for services will continue to rise, and they might. But where's the issue? If consumers can't afford higher prices, which we see they can't, and services companies raise their prices, it means demand is coming down, and that is a huge factor here. Because when we look at the consumer price index shown in blue against total incomes in red, what we see is where incomes go, well, you will see consumer prices follow. And despite the fact that total incomes from workers remains relatively high on a year-over-year rate of change, what we're seeing is prices are too high, and there's the other side of the story. Again, it's the labor market. It's not those who are working, it's those who aren't. We go back and look and we see these trends. As you see a decline in incomes, eventually inflation does come down. Yes, you can see it rise, but as we go back through history, you see slowdowns in income mean eventually inflation is coming down in a big way. Because the other factor here, the unseen factor, is in the unemployment rate, which while remains historically low, right around 4.1%, what it suggests is there's enough people on the unemployment line that don't have income to spend in the real economy, and that is causing a decline in demand. We see the relationship between the consumer price index and the unemployment rate telling us that there's a reason why things are getting worse and why higher prices will be rejected. But as we turn to S&P Global, we get a much different picture than the ISM. As new orders grew at a solid pace, it was broadly in line with that seen in December, despite signs of weaker international demand, which makes perfect sense. Firms nevertheless continue to scale back staffing levels marginally amid uncertainty over future demand. So while they're seeing a bit of an increase here for the holiday season, they're not convinced it's sustainable. That's something I completely agree with. On a price front, companies raised their charges at the joint slowest pace in almost 4.5 years, in spite of a further sharp increase in input costs. And what that indicates is that consumers can't afford higher prices. Companies know this, so what they're doing is they're incrementally raising their prices, just trying to pass across any increases they have, because they know, again, their customers can't afford it. But if you're looking for an opportunity to make money, look no further than Janover Inc., our sponsor of today's show. You can find them on the NASDAQ under the symbol JNVR. We're take a look at that chart setup again, and I'm going to give some more information. But as we look to Janover, you can find all the information in the pinned comment and description below, because they're making faster and smarter deals for all. From solopreneurs to the world's largest financial institutions, we help businesses find the right opportunities and act on them. And Janover is the AI-enabled platform that powers faster, smarter commercial transaction. Our suite of commercial real estate, small business, and lender products make sourcing, evaluating, and closing the right opportunities frictionless, driving better outcomes from all. From solopreneurs to large institutions, we're revolutionizing the way deals get done. And let's talk about the recent press releases. Janover enters a licensing agreement with leading commercial real estate services firm to provide AI client engagement tools. And Janover is excited to announce a licensing agreement with one of the nation's top 20 publicly traded commercial real estate professional services firms. Through this partnership, Janover's AI tools will be deployed to enhance client engagement and streamline communication, setting a new standard for service and efficiency in commercial real estate. This agreement marks a milestone in Janitor's transition to a subscription revenue, including licensing its highly customized conversational artificial intelligence. This deployment with a major industry leader underscores the real-world demand for our AI as the battle to deliver better services and data more efficiently than incumbents ensues. We're excited to see how our technology can push the boundaries of value delivery and cost structures further, even for the biggest players in the world. We're building technology that augments existing teams and functions. Our focus is enhancing experience and reducing friction across every touch point in ways that were simply impossible just 24 months ago. Here we're going to look at a bigger picture view. This is going back. Was that set up before? We featured the stock back right here. It gapped up that night before and then took off about 35% in intraday trading, putting some big money in our subscribers' pocket. You see this line here. This is, of course, the bottom of support. You see the stock sitting right above here. A small move higher leads to what I believe is a breakout and a 35% move matching what we saw previously. And here, let's take a look at the 30-day chart. What do you see? Rising momentum across the RSI and MACD. And here you see that volume profile line. What we're looking for is a close over that 56 level, and then it's breakout city. What we believe Janitor stock could rally up to 76 cents a share or higher, and that would put a 35+ potential return in your pocket. But as always, with any company we feature on our show, you're under no obligation to purchase their stock. Be sure to do your own research before placing any trades. And with that, I'm Steve Van Metre. Thanks for watching. Thanks for being fans. Bye now.